Hi, everyone. Today we will speak about the investing business startups and speak with Svat, who is the great guy and the great friend and acquaintance of mine. Hi,
Yeah.
Svat. It's really nice to meet you here.
Yes. Nice to meet you here today. I'm really glad to see you here. I'm really glad to will hear anybody, any comments, any questions from your fans. Yeah. I think today it will be like a versus between startup and business investing. For sure, like disclaimer, the balance is the best. You cannot pick only one option and invest only in one project, only in one type of asset and be happy till the end of your life. First of all, I wish you and all of your guys a very long and happy life. The second one, you cannot bet on only the one deal. Yeah, today we just discussing this, and it will be like, what is the difference? What about liquid? What about the upside? What about risk? How to find the project?
Mm.
We are talking about private equity businesses and private equity startups. If we will compare public companies versus startups, it will be like absolute different worlds. So I think it
I
will
think
be
we'll get
much.
that. So I
Yeah.
just offered to structure our conversation in such a way that, so I think it will be really great for the listeners to hear about us, about our couple words, about our experience, knowledge, and who are we and what we are doing. And then
Yeah.
we can split the questions between each other. I have several questions for you in terms of investing in startups because it's really interesting. And most people right now is take some closer look at that. And I just know that you have some questions to me as well.
Yeah. Absolutely
So
right. I
just
totally
to
understand. Yeah.
begin with some introduction, a couple words about yourself, and then I tell some words about myself as well.
Okay, so let's start from me. Yeah. Okay, I'm an investor. Previous, I was a businessman and serial entrepreneur for 5+ years. For the past 2 years or like up to 3 years, I am an investor in startups on early stage. Previously, I invested mostly in pre-seed and seed stages. Right now, I invest in Series A and Series B. This called like early growth because the company already have a strong dynamic, strong traction, but still in the early stage. Yeah, and it's still a not a very enormous and huge risk, but it's a big risk compared to most late stages. But also we have a great upside. So I'm targeting my community and I targeting around 5 up to 10x or more, but let's be realistic, 5 up to 10x just in 1 2 years of waiting after investing in the company. I think it's okay to risk in because you can get a really great upside. And also on this stage, like Series B, only like 10% of companies will fail completely. Yeah, it's not the same situation as pre-seed round where if 5% companies will survive, it will be very lucky. So yeah.
Got it. Yeah, that's fantastic. A couple words about myself, just to as the audience get a clear understanding. So basically, always also came from the entrepreneurial business world. Have a decade of experience in IT and started several companies. I exited from a couple of them to private investors, and now transferring my path to private investors as well in public and private equity, not startups. Right now, I have two companies in the portfolio and negotiating with several others. And my focus right now is more strategic role and helping with the scaling of the business, looking for synergies, for the optimization, automation of the businesses, and bringing different resources to the existing companies. And yeah, I'm a huge fan of investing in value concepts from Warren Buffett and other gurus. I have the portfolio of public equities, which I'm managing right now. That's not so big, but it's increasing right now, I would say. And yeah, I've been in constant look for different meetings, networking, and sharing knowledge and experience with people who have this demand and trying to show that business investing and finance is not so complicated if you understand where to look and what to read and watch. Most information is free. You just need to look and read the proper things. Had a couple of questions to you connecting to the startups and basically investing in those fields because you mentioned you are currently investing in Series A and B startups. why startups? Why are you going on this stage? And what's the main difference? What made you pick this type of investing right now?
Yeah, maybe I partially answered this question before in my introduction because I already told about I'm targeting the 5 or 10x, like around 10x after 1-2 years. So this is the main reason for sure. Like I'm investing in startups in the early stage for the money. If you're investing not for the money, I think you would be very rich person. Like really, you have a very big wealth to not mind about money when you're investing because investing it's about money. It's about what upside you have, what risk you have, and what is your management of your wealth. Yeah, previously I challenged some businesses with my own, and I did some companies, some projects. So I understand how it works from inside. I have many people like in my network who are entrepreneur, who are businessmen, and like many years, like decades. So I have a strong network to understand, to explore the projects that I'm exploring for investing with my community. And then we invest in it and waiting for the upside, as I told, like around 10x in 1-2 years. And I already have 2 cases. Yes, so this working. And I'm really happy because if you already have the results, you understand that you much more free in the next steps, in the next deals.
Got it. Maybe some questions from your part. We would just
That's
split between
right.
one-to-one questions.
Yeah, I'm
Yeah,
not
yeah.
playing in this game. Okay, so I just want to pick up the best one. Okay, I think it's really interesting. What's your quick checklist before buying a stock or a private stake in the business?
Basically have pretty decent checklist on business, connecting and comparing different factors. First are the numbers for the specific business. If we speak about the public equity, it can be either amount of cash flow the business has, the percentage of growth it has. For example, if I see that, okay, in the P&L, the business is negative, but at the same time, it has the cash flow. So basically the cash on hand, like for 200 or 300 million. So basically it's coming at the business and it's grown 30% year over year. I see that there is something here. So next, in terms of numbers, the percentage of gross margin. So basically the difference between the revenue and the cost of goods sold. I personally focus on IT, but very different type of businesses as well. So when you have the gross margin of 90%, 80%, and we all live in the different environment, for example, in risky situations, and not everyone is perfect. So you can make mistakes. So having those high margins can risk you out of making these mistakes. Even though you make them, you have the decent percentage in your P&L to cover that. On the other hand, if you have 2% margin or 40% gross margin in some businesses like retail, etc., if you do the mistake, it will cost you like 0.5 of the margin. You're already in negative part and the negative level. So it's really, there is no room to growth there and there is no room for mistake. Next is the amount of shares you have. So basically on the market, because the companies often provides more shares to the market, it means that it's either growing or on the other hand, it's just diluting the value for the shareholders. But there are basic things. Of course, return on equity, return on investment, return on assets, general metrics for specific things. The other part of the checklist is the management. Quality is the management who is managing the company. So basically, what are the experience? Do they have the knowledge from the similar industries, from different industries, if these people were hired from other companies? What are their ideas and strategy about the business? How they speak, what they speak, and how they fulfill the expectations of the investors. Usually when you watch and read about the CEO, he or she can tell one thing and act completely different. And it creates different misunderstanding. And it's really hard to invest in this company because you don't know what to expect. But when you see that the person keeps his words and he promises that we will bring the company to this level, and that during the 25-year period, he did the same what he told to the owners, shareholders, employees, So there is a probability that it will continue to do. So basically the people, the management, and the two key people, so CEO and CFO, because basically these are two main people who can understand the main business and define the strategy either financially or the general. Of course, marketing as well, but the most top management, all top management are. And the third one, maybe compared and connected to the trends and the economy. So basically, it's either internal economy, what makes this company really competitive in terms of the secret sauce they have, or how they do this differently due to the numbers, the economic mode. And is it the suitable situation for them on the market? Are there any headwinds or tailwinds on the market in terms of conditions? And will it help them to grow further? These are the main criteria, but of course there are a lot of them, and it's really unique and specific for the specific businesses. I also had this similar question to you on what makes the startup fundable for you and for your investors. Are there specific criteria for that, and how does it work?
Yeah. First of all, thank you for your very big one. Because I thought it will be like this thing, top 3 criteria that I already checked in every. No, but not like this. Your answer is really great. I can mark many things from this list about startups too. For example, what the founders say and what they really do. This is absolutely similar in startups. You need to understand what they are telling investors, what they are telling clients, what they are telling partners, what they are telling colleagues. Yeah. For example, I invested in the company in this year, in first half of this year, and they by January, first month of this year, they said their forecast for this year it will be 100 million ARR. Yeah. And already by the last report, the last numbers that I got this month in September, they already have around 100 million ARR by their run rate right now. So I think it's really meaningful and important to make what you promise. Not all things belong to you. For sure, you cannot control all the things. This is the main thing about entrepreneurship. You cannot control the market. You cannot control like the partners. You cannot control everyone's minds and something like this. But you can control your own resources, how to handle it, how to spend it, how to invest it, with who working, with who not. I think it's really a great idea to see what they are doing, what they are promising, comparing it if you have the information, because for sure it's hard, especially on early stage. Yeah, especially if this is first round. So I never invest in first round because it could be so inflated. You can't compare it with like you have nothing to compare because this company have not any rounds before. Or if it's the last round pre-IPO, I'm not investing because it's the last round and then it's on IPO in most cases. It's overhyped, and lately I uploaded some videos about this on my accounts. What I'm looking for in startups, first of all, and this is the meaningful thing, the most criteria to follow, this is traction, okay? Dynamic. This need to be strong. This need to be very positive. This needs to be fast growing. What you said about like 30% year over year. In startups, I'm targeting companies what made 5x year over year. For example, their revenue. In startups, it could happen because it was a seed and now it's Series A. Or it was a Series A and now it's Series B. It could be still like few X returns year over year. I'm 100% sure that this company will be growing more in few next months on a few years because inertly, yeah, they already have good numbers and they cannot stop. Even if they stop any marketing, will have clients because of retargeting, previous contracts, previous videos, previous posts, previous collaborations. I don't know, like any marketing activities previous still will give their client. But if they looking for a good round, looking for a good amount of money to go on new For example, in USA, it's easy to scale over another states. Yeah, so you already open it, for example, in 4 states, and now you get money for open it in another 20 states. So it will be easier. It will be easier than in Europe. For example, if you're in France, you want to open in Germany. This is another market. Yeah, the United States is the most uncommon. First of all, it's traction, strong traction. Second is founders. I need to understand founders and team. Yeah, not only the founders. They have expertise in such a niche they are doing. And for sure, it's a great upside and expectation of next round. If founders or fund where I'm investing with only talk about high expectation, like this startup will be next big thing, I'm not investing because I not understand what is the horizon of my investment. I need to understand it will be year, it will be 2 years, it will be 5 years. I don't want to go for deals for 5+ years right now. I'm targeting for 1-2 years exits. So yeah, this is my top 3 criteria.
Got it.
Let's move
Yeah.
for another question for you. Yes. Okay, how you understand that you need to sell share that you bought previously? I asked you not about the positive scenario, like you plan something and this happened 100% exactly. No, I asking about another scenario. You know what I'm asking for.
Yeah.
So what is your, like, how you're doing this on the situation that you cannot hold it anymore?
Got it. These situations happen, and I try to have them less in the portfolio and the praxis. The main reason for this happening is, I think, several. So first, either the market do not reflect and do not understand the value of this company, so it just decreases that, or there is something happened on the market due to some unrecent news. For example, there was the situation in a couple of years ago that there were strict regulations about Meta ads, for example, and the Meta dropped like 30-40%, and everyone thought that, hey, now it's the end of Meta, but they forgot that it's still the monopoly, almost a monopoly, I think. And they have way more data to target the people. But on the news, it just decreased, and it may affect the results of your portfolio. The third is something wrong with the business. Personally, the main reason to sell the stock, the shares, is when something has changed in the economy of the business, inside economy, and the business is not worth so much as I expect. So for example, when I purchased the business, I try to calculate how much the business is worth in general. And then I compare this internal market cap with the market cap on the stock exchange. And I see that, for example, if I have the company who earns 400 million a year, but it's for me is worth 100 million in my internal market cap, and the market values it's like at 30, I have a bargain. And the vice versa, if I see that it should worth 100 or $30 million and the market values it way, way more, I can sell it. I look at the company owner and I see how the company can grow in this field like 30% year over year. It's impossible because there are some regulations. So that's great misunderstanding between the price and the value. The change in the management, I see that the business is great, but the management or other type of the inside parts is changed. For example, the CEO has changed and he or she creates completely different strategy from the previous person. It can completely change the way the company works. It can become less, or maybe powerful or something like that. And if I don't like, I can change that. If I see there are certain like regulations or general information which can affect the competitive mode of the company, I can also sell it. But in most cases, if I see just the general outlook of the business, some trends like AI, etc., and I see that the company is just affected by the hype, the general news, and all these things, I just sit and wait. And I understand that the company can worth like 400 million, now it's 100 million, but it's still growing, it's profitable, it has decent numbers and economy. It has a great management. So we'll see. And usually the market is like unpredictable thing. It's like drunken alcoholic who do not understand, because today he has like the optimistic mood and everything is great, and tomorrow he fall out of the cliff because everything is sad and AI will take us all, etc. This affects the prices. So we never know. I guess these are my criteria for that. My next question to you in connection to that. So basically, you spoke that you're looking on the traction and the growth of the company, right? And we all know that there are certain differences between public equity and startups, because in public equity, you have general and open information. And it's usually proven because you can go to jail in the US if you do not provide
True.
information. But if we speak about startups, you usually deal with this kind of unknown information, criteria, and things you do not know. How can you personally spot and feel the difference between the real demand on the startup and the fact traction? Usually, the team can be very energetic and passionate about something, but that it can be affected, and there is some risks here.
This is a really good question, because this is why I always tell people you need a co-investor. You need some guys. This could be a fund, like venture capital fund. This could be a syndicate. This could be your friend. This could be your colleagues. I don't know, like any guys who understand what you are doing. And the best one, if they will be experienced than you. For example, as I mentioned, I have some guys who already millionaires, who already investors for decades. And I can ask them about every deal that I want to enter, every startup, and discuss about. If I want to invest with some of syndicate or some of fund,
Yeah.
I ask about this fund or syndicate from my partners. If they have a good reputation, I will invest with them. I trust what they give me as information. Like they do due diligence. I cannot do it. I have no resources for it, because due diligence of these Series A, Series B companies, it's about 100, 200 million valuation. So it's not the very small startup. They're not dealing with individual investors as me. Yeah. So they dealing with funds. And me can enter by a group on investor, like investment syndicate, only this option. Because another one, you need to be like a very wealthy people who can enter with million, 5 million for one deal. And this, you need to have an incredible big capital for it. My average check for investment, it's around $10,000 right now. So it's not that big to have a discussion directly with projects. You have the information from someone, like the founder of this company, or from the syndicate that you invest with, or with venture capital fund with what you invest with. So you need to trust someone who give you the information, because you alone cannot get this information. The company valuation is $200 million. They raised, for example, 50 million. Yeah. Why they need to have a Zoom with you for your $10,000? This is, I think, a good question to be asked before you want to get all information directly from founder. And if you have Zoom with you and another guys, just a retail investor, you're not a friend of them, you're not a partner of fund with them, just a regular retail investor, it's a big red flag. Because if they doing these Zooms, I think they not have a 200 million valuation. They not have a round for 50 million allocation, because it's more like something like a scam. So never ever doing things like that. This might suggestion for people who want to invest in startups in early stages.
Not a financial advice, because you have to need additional information from your personal advisor for that. We strongly recommend it.
And do your own research. For the average deal, like startup, public equity, real estate, everything. So I want to ask you about the biggest risk in public companies and how you hedge this risk. Like you already answered, maybe you partial answered this before your previous answer. Yeah, you said about if this just about news and just about hype on something, you just waiting. Yeah, you're just waiting because you understand this is a good company and this will grow. But if not, what happens if not? How you hedge this risk?
I think the main hedging of the risk is diversification, but it really depends on the specific person. Personally, I have stocks in the portfolio, so I do not over diversify when you can purchase like 20, 30, 100 stocks. At some point, it's like over concentration of the portfolio, which is not so well for other people. But when you understand the business, it makes it easier. For other people, just most advisors recommend, and other people recommend to diversify. So basically, split between different baskets. And so for me, it's just diversification. Even if something goes wrong, I have 9 other stocks. I have no more than 10% stake in one company. So basically, for most people, it can be either super super small portfolio of stocks and focusing on different. But at the same time, inside these 10 companies, I try to invest in holdings. For example, I have one company in the portfolio who has 80 companies inside them. So basically, when you invest in one company, you have the diversification inside them because they are diversified between industries, geographies, different companies. They also own the stocks of public companies and the private ones. They do startups, established businesses, roll-ups, they sell the businesses and vice versa. So basically, it's the diversification inside that. Besides diversification, I just try to target the companies who have the decent amount of growth, percentage growth, and can make 2, 5, 10, 50x in several years, basically. But in order to do that, you just need to understand the business, the economy. Besides this specific business, you need to understand that even though this hidden gem is not recognized, it will be, because the economy of the business is so unique and great. It's growing so fast, or even if it's not growing yet, it can be after some period of time due to specific circumstances. For example, there were crises in 2008 or with COVID when a lot of offline companies were struggling with sales and a lot of companies dropped in price. Some companies like funeral homes also dropped in price. But at the same time, almost all of them have the decent cash flow, for example. Or other companies in the, not the retail, but in the IT field, in the like semiconductors or logistics, which is some kind of seasonal. So they didn't drop, or they actually either dropped due to the whole situation, but they were profitable. And here's how I try to diversify. The second part of diversification is not only inside the portfolio of companies, but adding additional different asset classes like private equity deals. I also now in the search for real estate as well. You can diversify between different asset classes to be more stable in this case. Because on the one hand, the private equity and public equity actually is more long-term play and long-time gain. At the same time, private equity can give you cash flow and resources for this long-term thing. And at the same time, the real estate can give you also the cash flow and some opportunities in order to restructure your portfolio. Yeah, I guess this is for me, but it is really personal because it really depends on your knowledge, skills, and ability to risk, and the geography, because it depends on the opportunities you have within certain level of portfolio, countries, and this type of thing.
This is the reason we are recording and doing this live, to share with people more information, real experience and thoughts about different types of investing, different nature of investing, I think. Because I'm really very tolerant for risk, very tolerant for risk. And I'm okay about lost all of my money in one project, in another one project, because I understand that 1, 2, 3 startups will give me 10x and I will be happy. Yeah. With if one of 3 company, yeah, will be 10x for me and another 2 will be absolutely bankruptcy, I think I'll be happy because at the end of the day, you will have 3x on your portfolio. And this much more than you can evade. For sure, I want to, it will be like from 30 to 50% of successful deals. Right now, I'm on track with it, and I hope it will be in the future. In startups, this called really awesome statistics. I hope it will be, but I am absolutely okay to face another reality and to have less percent of successful deals, but still be in the profit. Yeah.
Got it. And my question for you is also connected to the startup. So you told that you are investing as the co-investor, the main fund or annual partner, and you have this type of group syndicate where you invest the pool of money with your investors. If we compare this to public equity, you just press the button and purchase the stock, right? But when we speak about investing in startups, you obviously have some paperwork to do, for example, like contracts, like due diligence, etc. And you tell that your partners do that. You still need to negotiate deals for you and your investors with your partners and the startup if needed. What are the criteria and what are a go and no go inside your deal options which are suitable for you in terms of the contract and your investors, and what are not?
Okay, this is really interesting. I think it will be the last question because so it not will be the very big record for the guys who want to listen it in the recording. Yeah, and this awesome the last question. Because about paperwork, about all the things, yeah, funds do it and my partners do it and I'm do it, so yeah, we together do it, yeah. And for sure I check the contracts, not every single time, yeah, to be very honest with your listeners, not every single time. It could be risky, yeah, but if my close friend, a close knit partner will give me the deal and we invest with them and he will manage all the things and I just drop him my money by crypto, cash or bank transfer, so any option. Then I get messaged by him about how it works. Another one, it's about when I'm signing the contract, reading the contract, transferring the money, all the things for me and my partners. Yeah, for sure. That could be a few red flags, absolutely big red flags. First, something like you cannot sell your stocks for a very long time. I cannot name this long time because I didn't face this contract because I invest in good deals. Yeah. But if you have in your contract, you cannot sell your stocks, for example, for 10 years in startup, I think it sounds crazy. Like, I think it's the massive red flag for you. Another one, it's about something like I saw it one time. I saw it in the contract. This was about like founders can buy your allocation and another few articles. If you match it, if you match these articles, this looks like average. This looks like similar, simple articles, but when it's matching, my friend who is the lawyer said me founders can buy your shares back for any price. They name and this price will be right only for them and anytime. And for sure, I don't like contract like this because this sounds crazy when, for example, you got 10x returns after 2 years, for example, yeah. But the founders want to buy it back for the initial price and they have a possibility to do it. So this not about investing, this about you give them a free money that if something goes well, they just get it back. If something goes wrong, this is investment, venture capital is so risky. I don't like this. So these two things, I think it's the massive red flags. Yeah.
Okay. Sounds interesting. I hope that will be useful for the watchers and listeners.
Yeah.
Yeah, it was our last question for today. I hope there will be more of such videos and lives soon. Any other words you would like to share?
Yes, for sure.
Presently.
Thank you for inviting me. I appreciate it. And I think we will have more podcasts live and all the things because we are really a long time not dreaming about this. Thank you so much for a possibility to share about startups, about investing, about another nature of investing and another face of it. Also, thank you for the insight about investing in private companies and public companies. I just prioritize startups right now, but for sure I will invest in public companies and real estate. The only thing I want to say to all our watchers and listeners, you need to balance your portfolio. Nothing can beat your 2-jet holiday and all the things if you are betting only on one company and think it's a good idea. I had this experience. I don't wish this to anyone else.
It was really great to meet you here as well. And thank you so much for accepting the invite to this video. I hope our listeners enjoy this episode. And if you guys have any ideas, comments, and thoughts about what was going on in the topic and the information we discussed, just leave comments below or just drop the comments in the chat. And yeah, we try to answer for them as soon as possible. And thank you so much. We will see you soon and take care.
Peace.